The average investor underperforms the market, not because they pick bad stocks, but because they sabotage themselves. So what if the smartest move isn't picking better investments, but removing yourself from the equation entirely? While you're losing sleep over which stocks to pick, artificial intelligence is quietly revolutionizing how millions of people invest their hard-earned cash. But here's the thing nobody talks about. Robo-advisors aren't just fancy algorithms throwing darts at a board. They're sophisticated financial tools that could either be your ticket to financial freedom or a costly mistake wrapped in sleek technology. Today, we're diving deep into the world of robo-advisors without the sales pitch, without the fear-mongering, and definitely without pretending these tools are magical money-making machines. By the end of this video, you'll know exactly whether putting your financial future in the hands of artificial intelligence makes sense for your specific situation. Let's start with what robo-advisors actually do, because the marketing makes them sound more complicated than they really are. They don't outperform the market, they outperform you. At their core, these platforms use algorithms to automatically manage your investment portfolio based on your goals, timeline, and risk tolerance. Think of them as digital financial advisors that never take coffee breaks, never have bad days, and work around the clock to rebalance your investments. The process typically begins with a questionnaire that feels like a personality test for your money. Questions about your age, income, investment goals, and how you'd react if your portfolio dropped 20% overnight. The algorithm crunches these answers and creates a personalized investment strategy, usually built around low-cost index funds and exchange-traded funds. What makes this interesting is the automation aspect. Traditional investing often involves emotional decisions, market timing attempts, and the constant second-guessing that turns many people into their own worst investment enemies. Robo-advisors remove human emotion from the equation, automatically buying when markets are down and selling when they're up, following a disciplined approach that most individual investors struggle to maintain. The popularity explosion makes sense when you look at the numbers. These platforms now manage hundreds of billions of dollars, growing from practically nothing just 15 years ago. But popularity doesn't equal effectiveness, so let's examine what these tools actually bring to the table. The most obvious advantage is cost efficiency. Traditional financial advisors typically charge between 1 and 2% annually, plus whatever fees come with the investments they recommend. Most robo-advisors charge between 0.2 and 0.5%, a difference that compounds significantly over decades. On a $100,000 portfolio, that's potentially $1,500 in annual savings. Accessibility represents another major benefit. You don't need a six-figure portfolio to get started. Many platforms accept initial investments as low as $1, democratizing access to professional-grade portfolio management that was previously reserved for wealthy clients. This opens sophisticated investing strategies to people just starting their financial journey. The emotional discipline factor cannot be overstated. Human investors consistently buy high and sell low, driven by fear and greed. Studies show the average investor significantly underperforms market averages, largely due to poor timing decisions. Robo-advisors eliminate this behavioral problem by automatically executing predetermined strategies, regardless of market conditions or investor emotions. Tax optimization through automated tax loss harvesting adds another layer of value. The software continuously monitors your portfolio for opportunities to sell losing investments to offset gains elsewhere, potentially saving hundreds or thousands in taxes annually. This process requires constant attention and expertise when done manually, but happens seamlessly in the background with robo-advisors. However, these benefits come with legitimate drawbacks that deserve honest discussion. The most significant limitation is the lack of human judgment and flexibility. Markets occasionally behave in ways that don't fit historical patterns, and algorithm-based systems may struggle to adapt to unprecedented situations. The 2020 pandemic market crash and recovery highlighted both the strengths and weaknesses of automated systems. Limited investment options represent another constraint. Most robo-advisors stick to broad market index funds and ETFs, which works well for basic diversification but may not accommodate specific investment preferences or sophisticated strategies. If you want exposure to individual stocks, sector-specific investments, or alternative assets like real estate investment trusts, you might find the options frustratingly limited. The one-size-fits-all approach can also miss important nuances of individual financial situations. Complex scenarios involving multiple income sources, unusual tax situations, estate planning considerations, or specific financial goals might require human expertise that algorithms cannot provide. A robo-advisor doesn't know about your plans to buy a house in 3 years or your concerns about supporting aging parents. Customer service quality varies dramatically across platforms. When you need help or have questions about your account, you might find yourself dealing with chatbots or inexperienced support representatives rather than knowledgeable financial professionals. This can be particularly frustrating during market volatility when you most need reassurance and guidance. Let's examine some real-world scenarios to illustrate when robo-advisors make sense and when they might not be the best choice. If you're a young professional with steady income, basic investment goals like retirement saving, and limited time to research investments, a robo-advisor could be an excellent fit. The low fees, automatic rebalancing, and tax optimization provide significant value without requiring financial expertise. For someone approaching retirement with a complex financial picture including multiple accounts, pension considerations, and specific income needs, a human advisor might offer more appropriate guidance. The nuanced decisions around withdrawal strategies, Social Security optimization, and estate planning often require personalized attention that algorithms cannot provide. Middle ground scenarios present interesting considerations. Perhaps you use a robo-advisor for your core portfolio while maintaining a separate account for individual stock picking or alternative investments. This hybrid approach captures the benefits of automated management while preserving flexibility for specific investment interests. The technology continues evolving rapidly. Newer platforms incorporate more sophisticated algorithms, expand investment options, and add human advisory services for complex situations. Some offer goal-based investing that automatically adjusts strategies as you approach specific financial milestones. Others provide socially responsible investing options that align portfolios with personal values. Integration with broader financial planning tools represents another advancement. Rather than simply managing investments, some platforms now offer comprehensive financial planning, including budgeting assistance, debt paydown strategies, and insurance analysis. This evolution toward holistic financial management addresses one of the traditional limitations of pure robo-advisory services. The competitive landscape keeps driving innovation and cost reductions. Major brokerages now offer their own robo-advisory services, often with even lower fees or additional features for existing customers. This competition benefits consumers through better services and lower costs, but also makes platform selection more complex. When evaluating robo-advisors, several key factors deserve attention beyond just fees. Look at the investment methodology and whether it aligns with your beliefs about market efficiency and diversification. Examine the platform's track record during different market conditions. Understanding that past performance doesn't guarantee future results but provides insight into how the system handles volatility. User experience matters more than you might expect. You'll interact with this platform regularly, so intuitive design, clear reporting, and responsive customer service significantly impact your satisfaction. Many platforms offer free trials or low minimum investments that allow testing before committing substantial assets. Consider the platform's stability and longevity. The robo-advisory space has seen consolidation as larger financial firms acquire smaller competitors. While your investments remain protected by federal insurance, platform changes can disrupt your experience and potentially force difficult transitions. Integration capabilities with your existing financial accounts and tools can streamline your overall money management. Some platforms connect with budgeting apps, bank accounts, and other investment accounts to provide comprehensive financial pictures and coordinated strategies. The tax implications of switching platforms deserve careful consideration. Moving investments from one robo-advisor to another might trigger taxable events that offset potential benefits from better fees or services. This switching cost creates natural inertia that makes initial platform selection particularly important. Looking ahead, artificial intelligence and machine learning will likely make robo-advisors more sophisticated and personalized. Natural language processing might enable better communication between investors and their automated advisors. Behavioral analysis could help platforms provide more targeted guidance for individual investor tendencies and biases. However, technology cannot replace all aspects of financial planning. Complex life situations, emotional support during market stress, and strategic financial decisions will likely always benefit from human expertise. The future probably involves hybrid models that combine algorithmic efficiency with human wisdom, where appropriate. So, where does this leave you? Robo-advisors represent legitimate tools that can provide significant value for many investors, particularly those seeking low-cost, disciplined portfolio management without the complexity of active investment research. They're not magic solutions that guarantee superior returns, but they address common investor mistakes through automation and discipline. The decision ultimately depends on your specific situation, comfort level with technology, and financial complexity. If you're getting started with investing, have straightforward goals, and value low costs and simplicity, a robo-advisor might be an excellent choice. If you have complex financial situations, prefer human interaction, or want investment options beyond basic diversification, traditional advisory relationships might serve you better. Remember that investment success depends more on starting early, contributing consistently, keeping costs low, and maintaining discipline than on finding perfect investment strategies. Whether you choose a robo-advisor, human advisor, or self-directed approach matters less than actually taking action and staying committed to your financial goals. The most important step is simply beginning your investment journey with whatever approach feels sustainable and appropriate for your current situation. If your biggest investment problem is discipline, not intelligence, automation might be your edge. You can always adjust your strategy as your knowledge, wealth, and circumstances evolve over time. If this helped you think about investing a little more clearly, not emotionally, but strategically, consider subscribing. This channel is about building wealth the boring, disciplined way. No shortcuts, no hype, just systems that compound over time. If that's the kind of approach you want around your money, I'll see you in the next one.